Welcome to the Allan Small Financial Show. As always, I want to thank all our viewers for taking the time out of your busy day to spend it with us. Welcome to the first show for the year of the Allan Small Financial Show. This is the kickoff show, I guess, for the year. We're so excited for the upcoming year. This year promises to bring more fantastic guests. We're going to continue to explain and try to make sense out of these crazy markets, these volatile markets, the ups, the downs. We also want to continue to answer the questions that all of you, the viewers, have with respect to your portfolios, with respect to individual investment ideas. So we're going to continue to do the things that we've been doing, and hopefully we can bring even some more information to you this year. And that's why on every show, I always say, if you have any questions regarding the material, any questions regarding any of the guests that we have on our show, some of the things that they're saying, please put it in the chat boxes, YouTube or Facebook or wherever or however you're watching the show today. We'd be happy to answer those questions at the end of the show. And if I don't get to them this show, be happy to answer the questions during the week or perhaps on our next show. So let's put up the topics for this week's show. So we're going to start off by discussing trickier to forecast what will happen in 2024. Why do I feel as though it's harder or trickier to forecast what the stock market's going to do this upcoming year versus what I felt heading into 2023? We also have our usual segment, our This Week segment, where I talk about what I think is important for individual investors to consider over the next couple of weeks before you make your investment decisions. And as always, I have 3 topics for you to consider. The January effect. What is the January effect? Why does it always seem to happen? And why do people say, as goes January, goes the rest of the year? Stock market valuations. Coming into this year, a lot of individual investors, analysts, market experts thought the markets were a little bit stretched. Valuations were a little bit higher. Why did they think that? And what do I think about that heading into a new year? Oil price cuts. Who's cutting oil prices right now? Why are they cutting? And is this affecting the price of oil? Mood of investors. What is the mood out there for investors? I know heading into 2023, the mood was pretty negative. A lot of people were quite nervous that we could see a recession. Perhaps it would be a deep recession at some point last year. It didn't materialize, never happened. So what is the mood for investors in 24? Do people think that 2024 or in 2024 we'll see a recession? The one that we were supposed to have last year, was it perhaps just pushed out another 12 months? So what is the mood for investors? And we'll discuss that. And lastly, as always, your questions. I hope to get to a couple of questions today. I know we have a question that was asked from our last show that I want to get to and answer that question for that person. So answering some of your questions is what we're going to try and squeeze in at the end of the show. So without further ado, let's move on with the show. Trickier to forecast what's going to happen in 2024. I think it's a little bit more difficult coming into this year to say that things are going to go well or not so well, to say that maybe things will go well at the beginning of the year, maybe not as well in the second half or vice versa. And I think that's the case for 2 reasons. Number one, interest rates. We know now that interest rates aren't going to rise anymore, although the Bank of Canada and Federal Reserve still maintain they're data dependent. But for the most part, they've now indicated that interest rate hikes are pretty much a thing of the past, that we're pretty much reached peak interest rates. So now the question becomes, when will interest rates be cut? When will we see a reduction in interest rates? And we've seen predictions from the first quarter of this year, March, to the second quarter, maybe somewhere around June, to the second half of the upcoming year. And I think that is going to play a factor into how difficult it is to understand or to predict what's going to happen in the stock market, because we know that the higher the interest rates, the more the stock market struggles, especially interest rate sensitive areas. I also think it's difficult to predict what's going to happen this upcoming year because of how we entered 2024. 2024, we entered this year on a high note. The Dow Jones was at all-time highs. The S&P 500 near all-time highs. The TSX grew by almost double digits just in the last couple of months alone. So we came into this year on a high note. So can we continue to maintain that level of growth, or will we see a bit of a pullback? And I have a couple of charts here that discusses this, or that shows this quite well. The first one is the S&P 500. And you can clearly see that when we entered into 2023, we weren't at the bottom, but we were just off the bottom. So going into 2023, if you were someone that wanted to be a bit of a contrarian, as I've said on many shows prior to this, you would have been purchasing the NASDAQ or tech stocks and the S&P 500, which is dominated by technology and tech stocks as well. You would have been buying the market because the market was coming in very cheaply. Well, take a look at where we're entering 2024, and you'll notice that we are pretty much back to our all-time highs that we reached back in I guess in 2021, end of 2021. So as an investor, it's more difficult to buy into this market and to believe that this market can continue to move higher if we're buying in or if we're at all-time highs or pretty close to all-time highs. We have another chart here which clearly shows the same thing again, and this is the NASDAQ. And again, you could see that, no, we're not at all-time highs, but we entered into 2024 pretty close to all-time highs. And so for individual investors, analysts, market experts, investment advisors like myself, it becomes a little bit more difficult, when you dust off that crystal ball to figure out, what's going to happen in 2024. How high can these markets go? And I think overall, most people believe the markets will go higher, but it is difficult to say how much, when, etc. And I think, again, to me, it's all about being a contrarian, as I've said many times, buying things on the dips if they're good quality investments. Well, as you can see, coming into 2024, there weren't as many things that you could buy at low points or on the dips. The indices were near all-time high. So to me, that to me makes it a little bit trickier to be able to predict or call or make calls on this upcoming year. Our This Week segment always talks about what I think is important for individual investors to consider before you make your investment decisions. And our three topics for this show: economic data. We have a lot of economic data, primarily focused on inflation, coming out in just the next week. We have CPI data, Consumer Price Index, which is the headline inflation data in the US, coming out tomorrow. We have Canadian CPI or inflation data coming out next Tuesday. And we have Producer Price Index, which is your wholesale prices, coming out in the US on Friday. So a lot of economic data to parse through. Corporate earnings. I think individual investors need to pay attention or start paying attention to another corporate earnings season. We have the kickoff to corporate earnings this Friday when your major US banks begin to report. Wells Fargo, Bank of America, Citigroup, JP Morgan, all will report corporate earnings come this Friday. And last on our list, increased market breadth. What does that mean? What does increased market breadth mean, and why is it important? I'll touch on that as well. So let's get to our first point, economic data. And as I said, tomorrow we will get US CPI, US inflation data coming out. Obviously, a market mover. If inflation continues to fall, that is a positive for the markets. Perhaps it gets us closer to the first interest rate decrease. If we continue to see inflation data above 3%, perhaps the Fed puts off the first interest rate decrease this year. So that's going to be a definite market mover. We also have Producer Price Index out of the US. That's coming out, as I mentioned, on Friday. These are wholesale prices, also a number that can move markets. And here we are, coming to our first chart, which is US Consumer Price Index. We've seen this chart a number of times before, and you can see here that when you strip out volatile food and energy, core inflation rate is still at 4%, well above what the Fed would like to see, which is 2%. In Canada, we are also well above 2%, where the Bank of Canada would like to see us as well. And you can see here the headline number, the top line number, 3.1% is the inflation rate in the US right now. So we'll see if these numbers come down, and we'll find out a lot tomorrow. The next chart we have is Canadian inflation and Bank of Canada target rate. And this is an interesting chart because you can see in that colored bluish area, you can see where the target rate is, the rate that the Bank of Canada would like to see the numbers falling into. And that is in that 0.5 to 2.5% range, according to the chart. But you can see that we have a CPI number well above that, right? We have total CPI in Canada coming in just above 3%. It's actually the same as in the US, about 3.31. And you can see some other numbers there as well. You can see the median, which is your average CPI or inflation rate, coming in above target rate as well. So overall, the next week or so will be very important. The data that will be released will be very important to investors, the stock market, interest rates, because if this number is a little bit warmer than expected, a little bit higher than expected, perhaps interest rates will slightly move higher. Perhaps if this information or the inflationary information is below what is expected, perhaps we see interest rates move lower. And with that, perhaps the stock market moves higher on that news. So very important to pay attention to the economic data. Our second topic is something that I think everyone should pay attention to, of course, corporate earnings. And as I mentioned, kickoff to earnings season always seems to start with JP Morgan, the largest bank in the United States. We have a picture, or I should say a chart for JP Morgan. We can probably show that. There it is. And I know we get some earnings from Delta Airlines. We get a few companies report earlier this week, but really things kick off. The earnings season is kicked off with bank earnings, and JP Morgan tends to be one of the first banks to report. This corporate earnings season, we're actually going to get 4 major banks in the US reporting earnings. And I think these are very important because we want to know what the economy or how the economy is faring in the United States. Has the most recent run-up in the stock market, is that justified based on what is going on with the economy? Has the stock market got a little bit ahead of the economy? Perhaps some of these stocks are doing a little bit better, and maybe we should see a bit of a pullback over the next quarter or two. So we have a few charts here. You saw the JP Morgan chart. We have one for Bank of America. And again, you will notice that the Bank of America chart, you're seeing stock prices for these banks really move higher towards the end of 2023 and into January of this year. Another chart that we have here is the Citigroup chart. Citigroup has probably been the best performer, I guess, them and JP Morgan. Look how steep that run up is in Citigroup chart. Unbelievable. This stock was under $40 a share, I guess, but back in November, the start of November. And here we are, well above $50 a share. Unbelievable run up. Not only would you've seen a lot of appreciation, but you've also would have been receiving an over 5% dividend while you wait for this growth. So an unbelievable chart, and it's something that for investors that have been buying Citibank, like I have for many of my clients, it's a great thing to see. And lastly, we have a chart on Wells Fargo. The chart, again, another steep run up in Wells Fargo, but you can kind of see it sort of flatlined in the last, let's call it last half of December and into January, still trading close to high points, but slightly below that. So we're going to get some really crucial corporate earnings out of the major US banks, and that's going to go a long way to tell us how the US economy is faring. Therefore, that will have an effect on the stock market. And as we know, us living here in Canada, what happens in the US stock market definitely affects what happens to the Toronto stock market as well. The third and final topic I wanted to discuss today is the increased market breadth. And what do I mean by that? Well, when you increase market breadth, you're increasing I guess, the momentum in a given direction. So in this case, the direction is to the upside. So when you're increasing the market breadth, you're increasing more, basically more things are moving higher than before. We know in 2023 that most of the gains were because of technology, the Magnificent Seven, which were primarily the big cap tech stocks. Well, I believe you're going to see a lot more companies, sectors of the market participate in the growth in 2024. And we've discussed this on previous shows. But now I have a couple of charts that will prove that theory is actually already happening. First chart we have here, US financials. And you'll see here how well, and we saw for the biggest names in the US and on the financial side, we've shown that US financials have now started to move higher to complement or go hand in hand with tech and how well tech has done. We also have a chart, which some of you would be surprised to see, are pharmaceuticals. We talk about pharma from time to time. I own it for diversified portfolios for my clients, and I think everybody should have a piece of pharma in their portfolio. Yes, we don't have many big cap pharma names up here in Canada, but there are a number of great pharmaceutical companies, biotech companies in the United States that have performed extremely well in the last couple of months of last year and continue to perform well. Name that comes to mind is Eli Lilly, right? Eli Lilly has a drug for that if you take the drug, it causes weight loss. And it originally was called for or used for diabetes, but now we found a lot of these diabetes drugs are also causing people to lose weight. And so Eli Lilly has one of the best. And interesting enough, Eli Lilly recently talked about how instead of going through agents or other sellers of their products, they're talking about actually going direct to consumer. And recently, that's caused Eli Lilly stock to move significantly higher. So interesting that we're seeing, again, pharmaceutical names moving higher, bank stocks moving higher to complement what we're seeing in tech. And we've also seen other names move higher as well, names in retail space as well. Some of your big retailers, whether it's a Target, whether it's a Walmart. Here in Canada, we've seen Canadian Tire move a little bit higher. A lot of different names are starting to participate, and that is what we mean by increased market breadth. So when you go to make your investment decisions over the next couple of weeks, those are the three things I think you want to pay attention to. I think you want to look at the economic data that's coming out in the next couple of days or next week or so, corporate earnings season. What are these major banks saying in the US about the economy? And lastly, I think you need to understand that the breadth of the market is widening. More things are participating in the growth, in the appreciation of the S&P 500 and the TSX. I think that's important to understand and incorporate when you build your portfolios over the next few weeks. The January effect, something we talk about every year, and probably if you rewind on some of the shows I've been on from last year, or our show here, or a radio show that, Sunday Money show that I do as well, or any of my appearances on BNN or CP24, I'm sure I've mentioned the January effect many times. And that's simply put, what that is simply is that January, we tend to see markets move higher. Plain and simple. We don't really know exactly why that is. Perhaps it has to do with tax loss selling. A lot of people sell their stocks in December. They wait 30 days, and then they buy back those same stocks in January. As we know, we sell stocks in December for the capital loss to offset against perhaps a capital gain that that investor may have. And as long as you wait 30 days to buy back that stock, you could then write off that capital loss against the capital gain. So perhaps it's because people are buying back stock in January. Perhaps it's because everybody comes back to the new year after a holiday season, Christmas, New Year's, and we're in a good mood and we're looking to buy. Not sure exactly why that is, but the January effect is real. And more often than not, January moves higher. And as I said off the top of the show, we can kind of extrapolate or go even further with the January effect and say, as goes January, goes the rest of the year. More often than not, if we get a positive January, we have a positive rest of the year. Now, it doesn't mean every month will be positive, but for example, last year, things looked good in January, and we had a great year. Although at times it was called into question, the end of the summer, September, October, markets moved down last year. But at the end, we had a very strong year, good returns, S&P 500, 24% growth. The Dow was over 12% growth, TSX around 7% growth, NASDAQ well over 40% growth. So the year was very, very good. We have a couple of charts here to show the January effect. You can see here, this one talks about all the months of the year. And you can actually see the best month of the year is December on average. And we talk about seasonality all the time. November, December, January. These tend to be put together the 3 best months of the year for the stock market and North American stock markets, but European stock markets tend to do well as well at this time. But you can see December actually outperforms January, but quite a bit. And there are other months that actually are a little bit higher than January. But when you factor in January after a strong December and a strong November, you can clearly see that this 3-month period is very, very strong. So overall, coming into a new year, I don't think you can just buy blindly into the stock market, just buy anything because the January effect is going to kick in. Obviously, there are no guarantees that every year the January effect will happen. But yes, more often than not, January tends to be a positive. And because of that, more often than not, as goes January, goes the rest of the year. And we see that the markets tend to do well on an annual basis more often than they do not do well. So yeah, I think January is a positive month. Hopefully we keep the, the streak going this year. So far, so good. We started the year off on a bit of a negative note, but we've seemed to rebound over the last few days. Market's been a little bit stronger, again, led by some NASDAQ and tech stocks in general. And hopefully that can continue for the rest of the month. Stock market valuations. So how important are stock market valuations? As I said, again, off the top of the show, a lot of analysts, a lot of what we call market experts, investors, they believe that the stock market was a little bit stretched with respect to valuations. When we look at PE multiples, they were a little bit stretched, getting in that 18 to 20 range for a number versus 16 to 18, which tends to be a little bit on the slightly inexpensive or cheaper, or maybe even fair value versus, in that 18 to 20, 21 range, which tends to mean a bit overvalued, definitely fully valued. And so, what does stock valuations mean? And what actually does it not tell us? And because it doesn't tell us the whole story, right? It's just a snapshot in time. You take a look at a stock, you can tell me, PE ratio is 10 times or 11 times or whatever it is, or 20 times, but it doesn't tell us the whole story. It doesn't tell us what the growth is. It tells us what the earnings are, but what's the growth rate? The PE ratio doesn't tell us that. And that's why many investors use the PEG ratio instead, price to earnings to growth, because we want to know if a stock has a PE of 20, but its growth rate, let's say it's growing earnings or growing top line at 30%, then maybe that's a stock you want to own, even though PE is a little bit high. But if it's growing at a 30% clip, then a 20 PE is cheap. So it doesn't tell us that. It also doesn't tell us what's going on within the company itself. It doesn't tell us what management is doing, what the CEOs are saying. It doesn't tell us what's going on in the future. Although, yes, we do have, future PE, forward PEs that we tend to use. I tend to use forward PEs quite a bit. But again, it's an estimate, right? You're using a forward earnings multiple or an earnings number. You're then taking the price and you're calculating it based on what you believe NVIDIA, Apple, or whatever stock will earn, whatever company will earn in the future. So you're taking forward earnings multiples, a forward PE. So stock valuations, is something that doesn't tell the whole story, but it is a very important story. And that's what we all track. And of course, if investors track it, and if it is important for all of us, stock multiples, then it's definitely important for all of you viewers. And it's obviously going to dictate how the stock market reacts. So here we have again a couple of charts. First one talking about PE ratios as a whole for the S&P 500. And you can see a huge spike in PE multiples in 2021. And that's also coincidentally when we hit our all-time highs on the S&P. You can see how fast they came down in 2022. And here we are again starting to rise. And that shaded area is, as I said, it's kind of the area that you're going to be in that fair market value area. When you start to get to the top of that range, you're kind of getting a little bit more expensive and a little bit overvalued. So a lot of people believe that PEs are telling us the stock market is a little expensive right now. The next couple of charts that I have here, we can show, again, tells us a bit of the PE or stock valuation story. The Dow Jones Industrial Average a year ago, 21.73, today 26. Again, a little bit higher. Transportation average, a little bit higher. Interesting enough, the utility stocks, the utility part, the Dow Jones Utility Average, lower than it was. And we know why that is, because we just came through a high interest rate environment. Utilities are interest rate sensitive. So we've seen utilities fall in value. You've seen names like Emera, Fortis, other utilities in the US come down from their high points that they reached a few years ago. So actually, utilities are a little cheaper than they were 1 year ago. Here you have some other indices just below. Russell 2000, actually a lot cheaper than it was 1 year ago, less than half. Then you look at the NASDAQ, a lot more expensive, trading at almost over 29 times. And lastly, the S&P 500, 21 times. Year ago, it was around just over 18, which is probably in that fair market value camp. So we're definitely seeing that valuations are a little bit higher. So people will ask me, Allan, should we still be buying stocks if things are a little bit stretched? And the answer to that question is yes, because we know that even though the index, whether it's the S&P 500, the Dow, the TSX, the NASDAQ, whatever index you're looking at, it may be they're telling us that the valuation on the overall index is high, but you have to look at each individual name within the index. And I can tell you that a lot of these indices valuations are high because of tech stocks. Tech stocks, which make up the majority of S&P 500, almost 30%, as we've discussed in the past. They're the stocks that have taken up the valuations, and behind it have been many good quality stocks that are actually still trading cheaply. So this is where you have to do your homework. This is where you need to consult an investment advisor, consult your investment advisor. Give me a call if you don't have an investment advisor or if you want a second opinion, because I will tell you there are a lot of good quality names to be buying now, even though the indices are showing or telling us valuations are a little bit stretched. The underlying stocks that make up these indices, I don't think they are as high value as the overall index is. And I still believe there are a lot of opportunities to make buys at the start of this year and throughout the rest of 2024. Oil price cuts. Who is cutting oil prices? Well, simply the Saudis. Saudis announced recently that they are actually cutting the price of oil to certain areas of the globe, Asia, for example. So they're not increasing production. Their production is now down well below 10 million barrels a day. United States, well over 13 million barrels a day. But what the Saudis, I think, want to do is they want more market share. So instead of, because the United States is producing so much, instead of these countries buying from the US, they want them to buy from Saudi Arabia. So the Saudis cut oil prices, making their product cheaper than everywhere else. And in my opinion, the hope is to undercut the price of oil from companies out of the US. We'll see if this works. It actually hasn't done much to drive up the price of oil. In fact, it actually brought it down on the day that the Saudis announced their recent cut in pricing. So I'm not exactly sure what the end game is here for Saudi Arabia. They obviously are saying, well, if the U.S. is going to be producing more than us and they continue to cut, and the United States continues to produce more, how can they, I guess, fight back? One way is to start producing more oil, which they know would further bring down the price, which is what they don't want to do. So instead, they think that cutting the price of the oil that they offer to countries around the world will have the effect that they're seeking. I don't believe that's going to happen. And as long as the United States continues to produce 13, and some people are saying it can get above 14 million barrels a day, we're hearing that smaller nations around the world are actually increasing production, Angola, Guyana, etc. We're hearing countries around the world produce more, even though Saudis have called on OPEC nations to cut more production. They did not want to this go around at their last meeting. And so the price of oil actually fell even a little bit more. And we saw oil for a brief moment in time below $70 a barrel on WTI. So going forward, what do I think is going to happen with the price of oil? I think we're going to continue to see it being range bound. Whatever OPEC, the OPEC nations and Saudi Arabia, plus one as they call it, which is the plus one is Russia, whatever they seem to be doing, whatever production levels they seem to have, doesn't seem to have an effect on the price because the U.S. just keeps producing more and more and more. And I think that will continue over the short and medium term. We have our usual chart here on light crude oil, WTI. So this is the US dollar price. It's not Brent, which would be the European price or the price they use in other parts of the world. You can see here when we took this chart, price of oil was about $72 a barrel. Obviously, it fluctuates. It would be different this morning because it moves obviously very quickly. It is a commodity, very manipulated commodity, and one that I always recommend owning a small piece for a diversified portfolio, but I definitely don't want to see people overweight oil. I know a lot of savvy investors overweight oil to start of 2023, and that did not work out so well. So heading into 2024, I will maintain my recommendation, which is you want to own a piece of oil. You want to own some oil companies that are producing dividends. The Suncors, the CNQs come to mind here in Canada. Suncor trading at 7-8 times earnings. Now you know what that is. So valuations are really cheap. And they're paying about a 5% dividend for Suncor. So those are the names I think you want to take a look at if you want to buy some oil for a nice diversified portfolio. So I wanted to talk a bit about the mood of investors on this show, because I often get asked by the BNNs, the CP24s of the world, Reuters or Canadian Press. I'm fortunate enough to be interviewed by them as well, and they always like to ask me this question: what is the mood of your investors or investors in general that you're speaking to? And I think to start this year, the mood of investors is a lot more positive than it was 1 year ago. As I mentioned, coming into 2023, the market was at lows. Coming into 2024, market is at highs. Now, for a money manager or investment advisor like myself, coming in at a high note makes things a lot more difficult. As I said earlier in the show, trickier to invest than if things come on the low end, because you always want to buy low to eventually sell high. And if you're buying it at a high, you're obviously predicting or hoping that things go even higher. So I guess investors in general, because things are at high points right now, I think the mood is pretty good. I think based on where interest rates are headed, where I guess what people are predicting will happen with interest rates, I think this is causing a lot of investors to be in a better mood. A better mood because their debts, hopefully the interest on their debt will come down this year. Hopefully they'll be able to borrow money at cheaper rates. And hopefully as interest rates fall, stock market picks up, whether it's in the first quarter or throughout the year. I don't know exactly when interest rates will fall, but it looks to be a positive year. And many people believe and are calling for a positive year, both in the stock market and in the bond market. One of the charts we have here, first chart, volatility chart, you'll notice here that bonds and stock and equities, and for a while there, I guess back 2021, equities were a lot more volatile. You see the spike in the equity line there. But recently, the bond market has been volatile. Why? Because as interest rates go up, bond price comes down. And so what we saw over the last couple of years is a higher interest rates, and we've seen bond prices really fall. But as many are predicting, interest rates will begin to fall. And we've already seen the 10-year in the US go from 5 to 4%, 10-year government bond, that is. And so what we're seeing is that the bond pricing is starting to rise as interest rates fall. So many investors are actually buying into the bond market, not for the interest necessarily that they're paying, their coupon is paying, but because they're buying these bonds at a very low price and waiting and believing that the bond price will move higher, just like a stock. And at the same time, we're also seeing some volatility in the stock market, not as much according to this chart, but we're seeing volatility in the stock market because, again, interest rates are coming down, stock prices are going up. So usually when stock prices rise, you tend to see volatility or the VIX not as high. Right now we're seeing a VIX somewhere around 12 to 14, which is historically very low. But bonds seem to be a lot more volatile right now, again, because of interest rates falling or rising and then falling very quickly. The second chart that we have here, and this is an interesting chart because this is a moment in time. This is where the money is flowing this morning. Wanted to get a snapshot as to where things were at this morning when this was taken. Obviously, the stock market has changed since then, but you saw the market money flowing into the Dow Jones, the S&P 500, the NASDAQ was roughly flat. I can tell you last time I checked before we came on the air, the NASDAQ and Dow Jones were higher. Markets were in general higher in North America. TSX, we'll see if that holds throughout the afternoon. The VIX was at a low point. There it is, just under 13. So everything seems to be great right now. Money is flowing into the stock market, pushing up some of the tech stocks, some of the pharma stocks, the bank stocks, retail stocks, a lot of the different areas. Market breadth is widening out. Everything seems to be going quite well right now. And I think for individual investors, overall, the mood for now is very good. And we're seeing it playing out in the stock market. So now the best time, in my opinion, the best part of the show, when I get to answer your questions. And I wanted to start off with a question we received from our last show. I guess it would have been last year's show, the end of last year, or our last show for last year. And this individual asked me, what are the ticker symbols for the oil stocks you are watching? Many thanks for the video. And at the end of last year, I talked about the three segments of the main segments of the Toronto Stock Exchange, which were oil, which is why this person is asking about oil symbols, banking, your Canadian bank stocks make up a huge part, or the largest part of the TSX, and gold or materials, which is the third part. And we talked about all three segments, but I actually mentioned a couple of ticker symbols already. If you're looking in Canada, which I have been recently, I like Suncor, SU, 5% dividend, trading at 7-8 times earnings on a forward earnings basis, which everybody now should know. We're looking ahead, predicting what an earnings valuation will look like, 7 times. Looking at it today, 8 times. Still very cheap and paying a great dividend of 5%. Canadian Natural Resources, CNQ, Charlie Norman Q, like Queen. They have a 4.6% dividend. Valuation's a little bit higher, but still not that expensive. Forward looking in around 11, 12 times. Current around 13 times earnings. So let's say in that 11 to 13 range. So those are two symbols I like right now. I used to like a lot of US symbols. One was Pioneer, although that's been bought by Exxon. One was Devon, which I started to liquidate recently. based on what's going on with their company. So right now, leaning a little bit more towards some of the big Canadian oil names versus the US. Another question here, a bit of a different one, actually. I live in BC and you are in Ontario. Yes, I am. Are you able to take on clients in other provinces? Interesting question. So when you invest money or you're an advisor here in Canada, yes, you can take on clients in other provinces. You just have to be licensed in those provinces. So I am licensed in British Columbia, absolutely. Alberta, Manitoba, obviously Ontario, Quebec, Nova Scotia. So I'm pretty much licensed across many of the provinces in our country. And I do have clients right through our country. And, these days, a lot of people, do things via Zoom or phone call or email. And business definitely does not have to be like it used to be, just around the corner or in your neighborhood. A lot of investors that I help are now right across the country. I'll take one more question. I think we have a little bit more time here. Do you find clients want more contact with their investment advisors when markets are volatile? Interesting. So another question regarding, I guess, my service or services in general. I guess the answer is yes. I think anybody wants more contact when things are volatile because that's when they're most nervous. When markets are moving up and down, especially down, people want to know why and want to know what they can do to protect what they have. And I think protection is whether it's growth first, protection second, or protection first, growth second. Every investor is different. But overall, in my opinion, I think that when times are difficult, when volatility has increased, so we see the VIX, which is the volatility index that shows volatility, when that spikes or moves higher, I think, yes, people want to contact their investment advisor either in person, via some sort of Zoom call, or over the phone. So I want to thank everybody once again for joining us for our first show in 2024. I'm very excited for the shows that we're going to have throughout the year. We're working on some really great things, some changes, some updates. It's going to be great. And I look forward to seeing all of you 2 weeks from today on January the 24th at 12 noon, as always. And until then, happy investing.